Hello and welcome. Going out to our Navigate clients today as part of our Pathway Passive Managed Portfolios. We've been lucky enough to be joined by David Betashares, Chief Economist, Head of the overall Betashares Investment Committee. So we're very pleased to have David here today, share some insights and knowledge about what's happening at the moment, but also what we're going to be expecting moving forward. So thanks for your time today.
No worries, great to be there, Callan.
Amazing. So ultimately, a lot is transpiring at the moment in global markets. Since the last quarterly update, what have been some of the key developments that we need to note and take stock of?
Yeah, great to be with you. Look, obviously the biggest thing in the markets at the moment has been the war in Iran, obviously the surge in energy prices and the risk to even food prices, like it's quite a broad-based thing. I mean, the markets have generally been, at this stage, hoping that we'd get what's called a Tucko moment, that Donald Trump would back down. You know, Tucko means Trump would always chicken out. So we've never been quite sure how long this war would last and how long the upward pressure on energy prices would persist for. So that's been the uncertain factor. But at the moment, again, we're seeing, even now, you know, we're seeing reports of you know, potential peace talks between the US and Iran. So hopefully, you know, this could end pretty soon. And importantly, I think what's happened is that there hasn't been a lot of damage to the oil production facilities. There's been clear blockage of the Strait of Hormuz, which is a temporary thing. So if that's all that happens, then the strait can reopen. I think the flow of oil can resume pretty, you know, reasonably quickly. But again, you know, we're in a sort of state of flux in terms of how that will play out at the moment.
And currently, with that in mind, what is the outlook in terms of the current tensions, and what could be the longer-term impact should the engagement?
Yeah, obviously, yeah. I mean, the big risk is that the war progresses, Iran start taking out the oil infrastructure of the other Middle Eastern states. Something like 40% of global exports of oil around the world come from that region. So if the production facilities are knocked out and there's a permanent block to oil production, you're looking at, you know, a big increase in oil prices and probably a global recession. I mean, that's the worst case scenario. And a recession with high inflation, like it's the worst of all worlds. And, you know, if that were to play out, I mean, basically you want to be hunkering down, you want to be cashed up because both bonds and equity markets in that environment wouldn't do well. But that's very much the worst case scenario. I'm not saying that's certainly our base case, but that's ultimately how things could go. But, you know, we still thinking that, you know, cooler heads will ultimately prevail and we won't get to that situation.
No, thanks for that, David. We're also fielding, and we have been for some time, questions from clients about the US more broadly, so both policy and also the economy.
Yeah.
What's the overall view of the investment committee in terms of the US as well as the outlook?
Yeah, look, first and foremost, the US economy is doing pretty well. Like GDP growth has been pretty solid over the past year. Two drivers. You've got tax cuts helping consumers. The big, beautiful bill that was passed late last year is providing more tax refunds to households this year. Also, the AI ramp up, you know, the hyperscalers, the Googles, the Amazons and Facebooks are still spending billions of dollars on data centers and computer chips, and that's helping underpin economic growth. Like the rest of the world, the US is at risk from higher oil prices, so that is a risk factor. But prior to the war, I mean, we were still, you know, pretty constructive on the US economy, didn't see any material risk of a downside. Now, the labour market has softened in the US, but again, a lot of the indicators suggesting it's more of a sort of a mid-cycle slowdown, if you like. It's not sort of careering into a big, you know, downturn. And I think some of that relates to tariff uncertainty that we had last year. That is easing. And I think some of it is maybe also an early sign of productivity payoff from the AI boom. Employers starting to, you know, feel that maybe they can economise on the use of labour. So to the extent it reflects a productivity boom, that's, you know, good for inflation, good for corporate profits, and good for keeping service inflation down. So yeah, I mean, I guess beyond that, I mean, in terms of the US, the question mark at the moment is, will the outperformance of the large cap tech companies continue? And we've kind of been of a view that we are starting to see a rotation toward cheaper parts of the global market, emerging markets, Japan, to an extent Europe, and associated with that a weakening US dollar. So although the AI boom continues and the US economy is holding up, I think what we are tending to see now is a rotation beyond the relatively now expensive large cap tech companies to other parts of markets, which we have reflected in our recent portfolio rebalancing. We have gone, modestly underweight US equities and overweight a broader measure of global equities, so giving us effectively an overweight to non-US equities and also an overweight to hedged equities because we think the Aussie dollar is going to continue to strengthen.
Great. No, appreciate the insight there, and I think our clients can take a lot of confidence in the exposure, particularly toward the US. A question back around the inflationary pressures that we are beginning to see. There's been positions in the managed accounts for some time, particularly around gold. We field a lot of questions from our clients, not only around gold, but precious metals more broadly. Where do you see that as an asset, and where do you see that potentially?
Yeah, so gold's had a great run. I mean, we've been overweight gold for, I think, at least 18 months, and it's really helped contribute to the performance of our models relative to our benchmarks. And so, just in the last 3 months to February, I think it was up something like 23%, and so that overweight has certainly helped. Now, with the war in Iran, funnily enough, gold prices have pulled back. So gold you ordinarily think is a safe haven in times of war. But what we've seen, I think, around the world is the most popular trades prior to the war. Things like the US dollar, the gold, Japanese equities, all the things that were doing well prior to the war have been the ones that have done less well since the war. And I think what that reflects is investors cashing up positions. They're needing to sell some of their positions to raise cash levels and fund their losses elsewhere. So we're not too perturbed by the fallback in gold. And fundamentally, look, again, assuming that this war does not drag on into a worst case scenario, I think the sort of trends we saw prior to the war will resume, and that being a rotation from US markets to non-US markets. Not to say the US market will weaken, but it will just maybe not perform as well. And the US dollar weakening and the weaker US dollar, we think will continue to support gold prices.
No, terrific. Thank you for that explanation, David. Really appreciate that. Then, with reference to the managed accounts, the recent quarterly tactical changes, are you able to just go through and speak to what they were?
Yeah. Okay. So the committee met mid-February. So again, importantly, this was prior to the war. Though of course we've been monitoring things since, and at this stage have not made any changes since that rebalance in February. And firstly, we kept a neutral position we pared back our overweight exposure to growth assets back in November. We basically held that neutral position into February. And within defensive assets, we've kept the overweight to gold and even the overweight to fixed rate bonds. So we're sort of underweight cash, overweight gold and bonds in defensive assets. But the one new, tilt we did introduce in February was within global equities, where, as I said earlier, we've gone slightly underweight US equities and favouring a more of a position in a broader measure of global equities, a broader exposure to global equities and hedged global equities. So again, the view there being US likely to maybe underperform and the US dollar to continue to resume its weakening trend. So that was the important development in February. And again, why we haven't made any changes since is that, again, we never know. At any given day, Donald Trump could decide the war is won and he's going to pack up and go home. We're seeing signs of that, as we speak. There's been some announcements of that in the last couple of days, which is why we've been reticent to, change the portfolios just in face of the war. We thought the pressure on oil prices and on stock markets would, bring Donald Trump to the table to maybe to pull back on the war, which seems to be playing out at the moment.
And we do hear a lot about the midterms elections in the US. Do you feel that will force Trump and the administration into looking to reach
Yes.
a peaceful resolution sooner rather than?
I think that's the. I mean, again, the Iranians. I mean, I think that what's happened. Again, I'm not a military strategist, but what seems to have happened here is the Iranian regime has been more resilient than the US expected. They've been able to maintain power. They've still been able to lob missiles and drones, albeit not as many as they were at the start of the war, but only needs one or two to cause angst. And particularly, they've effectively been able to close the Strait of Hormuz, through which 20% of oil flows. So that is the pressure they're bringing on the US. And again, the higher petrol prices in the US go, the lower consumer sentiment sinks, the greater the risk that the Republicans are going to pay for at the midterm elections. And I think that has been bearing on Donald Trump. So again, I think that's part of this. And again, as I said earlier, there's this thing called the taco trade. Trump always chickens out. I mean, it's probably a little bit unfair, but I mean, they have done a lot of damage to Iran and maybe set back their nuclear activities and their military capacity for many years. And maybe now seeking a way to extricate himself from the situation. Given that it's unlikely at this stage, unless you put boots on the ground to get effective regime change in Iran. I think they realise that that's impossible unless they put boots on the ground, which at this stage they don't seem to want to do.
Okay, and then in terms of the outlook, so hopefully we're able to find some optimism for clients looking the next 12 months. And no one has the crystal ball, but if you could speak to maybe what the next sort of 6 to 12 months could potentially bring for the managed accounts and client portfolios.
Well, first and foremost, we want to see the war in Iran end. We want to see the Strait of Hormuz reopen and oil start to flow and bring down petrol prices again. And then we go back to the world, maybe not immediately, but back to the sort of world we were in prior to the war, which has been the AI boom. Good global growth going into this war was pretty good. It was running at around about 3%, just above around about its long run average. Inflation broadly around the world, look, it has been coming down. And again, we've had a spike in energy prices more recently, but broadly speaking, we've had, pretty resilient global growth. Inflation coming down from the COVID highs. Central banks of a neutral to easing bias. The Reserve Bank is obviously a little bit different, but that's been I think an encouraging backdrop for markets.
Wonderful. Really appreciate your expertise, your insights. So we're joined by David Betashares and the head of the Pathway portfolio. So we're really pleased to have David's insights today. Thanks again.
No worries. Great to be with you.